What's up, everyone? It's Caddy with Money Vesting. So welcome on board for another, pre-market live stream today, not market open live stream. So I figured I'd go live a little bit earlier today, and also because I won't be able to actually do a live stream during market open today because I do have an obligation to tend to family obligations. So I will be away during that time. So figured I'd go over live right now for about an hour, analyze some stocks for you guys. I've got some spreadsheets open, so we are going to be doing a lot of analysis today to help you get the most out of this next hour. So thank you so much for joining it, everyone. Make sure that you drop a like, and welcome, Wilson. Thank you so much for joining. Good morning, wherever you're joining from. So pre-market, let's take a look. I think the markets are higher, so QQQ is pushing up, flat more or less. It's only up 10 basis points after the significant bloodbath that we saw yesterday. Yesterday, the markets were obviously very much, in pain. There's a lot of aggressive selling pressure. We were just selling off pretty aggressively intraday. It was down 2.6%. We got the SPY also selling off down a little bit over 2%, but pre-market right now more or less flat. 6 basis points, and then we got the Dow Jones, so DIA is more or less flat also at the open pre-market so far, and the yields are now back over 3%. So definitely pushing higher, quite a bit. The 10-year yields have been, and QT, don't forget, it starts on September 1st. That's when a lot of the maturities happen for U.S. Treasuries, mortgage-backed securities, and they will start to roll them off, and they will not be actively buying any more U.S. Treasuries and mortgage-backed securities. And by they, I mean the Federal Reserve, and of course, Jerome Powell. So, Mushtaq, thank you so much for joining here. Once again, everybody, thank you so much. Good morning. I know it's a little bit earlier, but again, for the next hour or so, I want to, again, dedicate this time for you. If there's any companies you want me to go over, I'm happy to analyze them. And we're going to take a little bit step further. I've got some spreadsheets open that, that will allow us to analyze these stocks from a more fundamental standpoint. So I've got the price to earnings intrinsic value calculator open, and then I've also got price to sales in case any company doesn't quite have consistent profitability. We're not able to get a good understanding of their bottom line earnings and net income. So these are going to be very, very quick, rough estimates as to what really to pay attention to in terms of that intrinsic value, intrinsic price per se. And of course, then we'll go over the technicals as well. So so let me know if there's any companies you want me to go over. It's a little bit early, I know. There's not really a lot happening. Pre-market volatility is slightly down 63 basis points. Oil, on the other hand, is now starting to break outside over $91, $92 again per barrel. So we are seeing a little bit of a breakout for crude oil at the moment, starting to trail back above $91, $92 a barrel. So up over 1.26%. And of course, Bitcoin's just been hovering sideways right now, just 22,000. And then of course, we've got Ethereum also just roughly at 1,600, 1,500. Has just been hovering back and forth around that level at the moment for Ethereum as well. So that's where we are. And then let's take a look at some of the earnings. So if you go over here, so earnings wise, Macy's and XPeng are scheduled to report pre-market today. We've also got JD.com and of course Dick's Sporting Goods. And then GM Smucker Company is also going to be reporting pre-market. And we got Intuit, Nordstrom. So those are some companies that are going to be reporting after the bell. And of course, later this week, tomorrow, Wednesday, we've got NVIDIA, we've got Salesforce, Snowflake, Autodesk, Splunk, and then Peloton, Affirm, some of those companies also reporting. This is a chart that I will go over later. I want more people to join in, and we'll talk about that, as we get closer to September as well. But of course, today we've only got the new home sales, Richmond Manufacturing Index, all that stuff. And then Wednesday, we don't really have anything that's super important, but Thursday, we've got the GDP numbers. That's going to be the second estimate for the second quarter. And of course, the Fed Chair Jerome Powell is also talking on Friday at 10 a.m. Eastern. So BTIG downgrades Zoom after video conferencing company slashes full year outlook. So I actually did a video on Zoom. Make sure that you do check that out if you haven't already. So I did a video, complete fundamental analysis on Zoom, going over their intrinsic value, going over what they actually reported in terms of, revenues, customers, earnings, cash flows, valuation, all that stuff, balance sheet. So make sure that you do check that out if you haven't already. And this is, why tech investor Gene Munster thinks Apple has an upside of more than 40%. So he says, and I quote, "I believe Apple will reach $250 per share in the next couple of years." Munster, managing partner at Fund Loop Ventures, and says, nevertheless, Munzer said the stock could still go lower before heading higher because of course, the overextended conditions we've seen. The stock has simply been on a rocket ship, and I think there is room for it to have some variation. I think it can and should have a pullback. I put under the context of trading, and Apple has emerged relatively unscathed from this year's bear market run. The stock lost about 8% its value this year, beating its peers within the FANG grouping as well as tech-heavy NASDAQ composite. So of course, Apple has been a very, very significant, safe haven stock where lots of people have been parking cash in. So, all right, let's see here. Hey man, do you think Tesla is a good buy at around $560? And do you have a video on your intrinsic value method? Yes. So $560, well, I have a video coming out for Tesla later today. Since I'm not going to be live during market open, I have a video on Tesla coming out. So that will answer your question. So in about an hour or so, there will be a video going out on Tesla. Of course, because tomorrow is the big day, right? Tomorrow is pretty much the last day for the stock split. So we will be talking about that, and I will be going over that in that video, and that intrinsic value, which even though I know that I'm going to be made fun of for that intrinsic price because lots of people kind of disagree with what that intrinsic price is, but it's based on the growth estimates and the P multiples. So that video should answer all your questions. And in terms of my method on calculating intrinsic value, it's a very, very simple process of just discounting all future earnings and cash flows back to present value. And then just pretty much, computing that intrinsic value based on the shares outstanding and of course the earnings as well. So there's no rocket science here. It's just a very simple process that pretty much is used industry wide. And I'm happy to share that in the Discord as well. I've done tutorials on that as well. So Oscar, thanks so much for joining. Welcome on board. So as I was saying earlier for everybody, again, this is the time for us to kind of, take a step back a little bit. Of course, pre-market, there's not a lot of things to watch out. There's a lot of distractions during a market open. So I just want to go over some individual stocks for all of you. So I'm getting a lot of questions about Disney. So let's take a look at Walt Disney. I have done videos on Disney as well. So if you go on the channel, if you look at stocks under 30 minutes, I'm pretty sure you can find at least 3 to 4 different videos on Walt Disney. But let's just quickly go over the company. So right now, just under $116, it has been selling off as well, similar to pretty much, every stock in 2022. It's down to 116 right now from all-time highs of $202. It's down about 43%. Recently though, from June 16, from July, as the markets have rebounded, it's gone up 31%. But one of the things about Disney is that with this recovery, with the reopenings and everything, they are really benefiting in terms of revenues and earnings, right? They are kind of going back to those same trends that we saw prior to the pandemic. And the overall subscribers for Disney, when it comes to Hulu and ESPN and everything, Disney Plus, Hotstar, Disney Plus in general, everything has now surpassed over Netflix. 221, I think, million subscribers is what they have. So for Disney, what we need to do is when we take a look at the revenues, right? October 2021, this was last year, fiscal year 2021, they did $67.4 billion. And the bottom line, which is their net income, was, let's take a look, was just under $2 billion. But so far for the trailing 12 months, they've already done $3.142 billion. So if you go over to, let's see, quarter over quarter here, we're going to do absolute and we're going to do quarterly. So we're going to take the last 2 quarters, which was January and April and July. So this is the last 3 quarters for the company. If you take a look at the net income, that's been $1 billion and $470 million, and then $1.4 billion for the company. So let's just quickly go over Walt Disney's earnings. And I'll do some analysis here, for us. So that's going to be Walt Disney here. So we're going to go over to the third quarter fiscal year 22 earnings report, and we'll try to see what the first 9 months kind of looks like. So revenues for the first 9 months grew 26% and 28% respectively. Diluted EPS for the quarter, 70 cents from 50 cents in the prior quarter. So if you come down, I want to see the first 9 months. There we go. Over here. Revenues were 42.3 million. That was up 12%. That was for overall revenue, including linear networks, DTC, and content sales and licensing. And then the bottom line is what I'm interested in. So all the way down. So again, this is going to be their total subscriber count. 152 is going to be total Disney, which is, including their Disney Hotstar and then international and domestic Disney Plus. And then of course, ESPN, Hulu, if you kind of, combine all those, they are now sitting at well over 200 million subscribers at the moment. And then let's see here, all the way down. All right, here we go. So Okay, so first 9 months, there we go. Net income is sitting at just over 3.51 billion dollars. And since the fourth quarter is really, really good, usually for these companies that are cyclically very much affected by it, so I'm gonna assume another $1 billion in net income for Disney in the fourth quarter 2022, and that's gonna bring our total to $4.2 billion, right? So if we plug in $4.2 billion for Disney, that's going to be 2022 net income, bottom line earnings, and then the share count is going to be over here. So share count is sitting at 1827. That's going to be, as of quarter ended, 1825 is going to be that number. We're taking the diluted share count. So 1825 is going to be that share count. So EPS $2.30 is going to be the expectation. Right now, for the first 9 months, they are sitting on diluted EPS of about $1.66, right? About $1.63 right now. So expectation would be for them to get up to at least $2.30, which I think is very reasonable for them to get up to after the entire fiscal year 22. Now, in terms of growth rate for Disney, that's where things get a little bit, challenging and of course very debatable as well. So if you come over to the growth expectations for the company, if you take a look at EPS diluted 3 years, 33%, that's the expectation among analysts. If you come over to earnings estimates over here, then you can see that that Disney is expected to grow. Well, analysts, first of all, they're expecting EPS of $3.86. My estimate is $2.30, which is really, really low. They're expecting a 66% growth. This might also be on a non-GAAP basis. I'm taking into account a GAAP adjusted EPS, so there might be a little bit of variance there. But they are expecting very strong growth, 65%, 40%, 19%, 16%, and all the way up to 8%. So if you kind of look at that numbers, 817 up to 386. So if you do the math there, 2022, and then the other number is going to be 2026. So we're going to go with 386 over here, 2026. And these are just going to be normal numbers. So $3.86, and the actual EPS $8.17. So when it comes to their actual estimates from the analysts, so over the next 4 years, they're basically projecting that EPS for Disney is going to grow by 21%. 21% is their expectation over the next 4 years, which I think is very reasonable as well. For Disney, I think that is a very probable outcome. But still, I'm going to be a little bit more conservative, and I'm going to go with 18% growth for Disney over the next 5 years, for 2027, all the way out here. And that's going to make our EPS go from, on a GAAP adjusted basis, from $2.30 all the way up to as much as $5.26. For P multiple, I'm going to go with 20. That gets us a PEG ratio of 1.1. Discount rate is going to stay put at 12%, 10% margin of safety, 1% share dilution. Obviously gets us a very, very low price for Disney, right? It gets us to $51.16, and that is based on a 20p multiple and an 18% growth rate. If you go with a little bit higher growth multiple, which is 26% in terms of the actual CAGR, and of course a higher P multiple, then of course you get up to closer to where the price is, $106 per share. But it really depends how conservative or aggressive you want to be with your estimates, and where do you believe Disney is going to grow in the future over the next 5 years. So again, that was a very quick analysis that I wanted to do for Disney. And of course, if you have any other stocks, I'm happy to go over for the next 1 hour, like I said. But let's see, who's ready for another red day? Oscar says, right now, pre-market, we are very flat. We've got QQQ just up over 10 basis points. And we got the SPY pretty much flat as well. And the Dow Jones is only up 1 basis point. So at the moment, right now, we're just kind of seeing a lot of consolidation after yesterday's selling pressure. And if you take a look at the charts over here, if you take a look at QQQs, you'll notice that we pretty much have seen 2 really back-to-back brutal days. On Friday, the markets were down, close to 2%, the NASDAQ was, and then yesterday, of course, we were down over 2.6%. So, we take staircase up and elevators down. So very, very quickly, we just came right back down to a very neutral level on the relative strength index at, about 48, almost 49 levels. So the next support really is going to be $307 for QQQs. I know somebody was asking about QQQs. So Joe says, do you think QQQ will make a new low? A new low as in on the year, Joe, or are you just asking like on a much shorter time frame? Are you asking like on the year? Is it gonna break below this June 16th level? Or are you asking just more on a shorter time frame, like maybe like the last couple days here or something? So yeah, let me know. But overall, I think the markets are resetting expectations when it comes to interest rates and where the Fed is in their hiking cycle. I think the idea that the Fed could pivot really piqued a lot of people's interest, and of course was the main trigger for this market rally, right? So 270 level for the year. Okay, so we were down to 270 levels back on June 15th, 16th. Okay, so new lows for the year. So again, that pretty much is a question, has the market bottomed or not? In other words, and this right here has been so far the low for the year. Now, for us to come back down to these levels, a lot of things would have to change significantly. Inflation would have to reaccelerate, meaning that inflation figures in the future months that we get for the prints would have to once again go back higher. Inflation, if CPI gets back over 9%, if it gets up to 9.5%, 10%, month over month, we see those changes, 0.5, 1%, 1.5%, and that would be pretty catastrophic for the overall sentiment. And of course, where we are with inflation and the Fed, they will again reiterate how aggressive they want to be. They will continue to be very hawkish when it comes to interest rates. And the one thing that allows the Fed to keep doing this, can anybody guess? Pop quiz. What is the one thing that right now the Fed can rely on that is allowing them to go forward with their aggressive rate hikes? What is the one thing right now? Pop quiz. Quick. So, yes, so Ken got it, unemployment, right? It's strong employment. Mushtaq got it, yep. Employment, good job market. You guys all got it, man. You guys are amazing. You guys are like on point. So yes, it is employment, right? It is employment being really, really strong, and we're right now sitting at 50-year low unemployment rate at 3.5%. The Fed can pretty much cite employment, strong jobs market, labor market to basically justify their rate hikes. If there's a shift in the employment picture, if there's any shift in the overall jobs market, if unemployment rate starts to go higher, then that will be a much bigger problem. Those are some scenarios where I could see the Nasdaq come back down to those lows, to its June lows, and even make even lower lows, right? Comes down to even new lows for the year. And that's a scenario where there's an official recession in the US, unemployment starts to go higher, and inflation is nowhere near close to their 2% target. And the Fed will then be in a very, very difficult place. They will pretty much be in a rock and a hard place, somewhere in between, and they would have to decide whether they want to keep raising rates or they want to start pivoting in order to support the economy once again. So it's pretty much the Fed fighting against their own dual mandate. So it's whether they save employment or whether they save inflation. And in that battle, what do you think the Fed will pick? That's another question. It's not a pop quiz because I don't know the answer to that either. I'm only going to speculate and going to answer with you. But in that scenario, what do you think the Fed will pick? Is it going to be a strong labor market and stimulating the growth of the economy and bringing inflation back, bringing employment back down? In other words, strong jobs market, avoiding a recession, or if it's going to be controlling inflation and keep raising rates regardless of what happens to the economy, just like Paul Volcker did back in the 1970s. So what do you guys think? What will the Fed choose over if and when we're in that scenario? So George says inflation, and I kind of agree with George here, controlling inflation. Andrew says controlling inflation here as well. Yes, and I kind of agree with both of you guys with inflation, because I think Jerome Powell's tone and what he has talked about. Yes, so lots of people saying that inflation keeps raising rates to combat inflation. I think that is what the Federal Reserve has talked about, right? What they have mentioned, that okay, we're gonna do whatever it takes. We will not hesitate to bring inflation back down to our target 2%. The main goal, and this is something that he's mentioned repeatedly, is to restore price stability. If that's their goal, nothing will stop them from achieving their goal, right? So I think they will prioritize inflation, controlling inflation and restoring price stability over a recession and over a very, very poor unemployment But it really depends on how far they will go to, right? How bad do things need to be before they finally call it quits and start to pivot and they say, okay, we can't control inflation right now. We just need to let it be for at least a few years, and then we'll figure it out in the future. But that really depends on the severity of that recession. Many people have called for a mild recession. I think the interest rates can, I think the economy can still handle the current interest rates, even if they go up to 3.5%, 4%. Even I think even as much as 5%, there's going to be some pain, but the economy can handle that. I think anything above 5%, 6, when we get up to 6, 7, and 8% ranges for interest rate for the Fed funds rate, that's when things get really, really tricky. That's when you start to kind of, you know, think twice before spending, think twice before borrowing, think twice before using credit cards and mortgages and auto loans and all that stuff, because credit, the flow of credit will really start to slow down, and it's just going to be really, really expensive to borrow money. So, right now we know that the Fed is going to prioritize inflation. Inflation is showing signs of improvement. And if it continues to come down, that's a good sign. That's exactly why I'm tracking oil prices. And I've repeatedly said that oil prices are going to be very, very important. Not just oil prices, of course, but everything else within the CPI report, inflation report. Because if inflation rolls over, that is a very good thing. That puts the Fed in a very good place. If inflation doesn't roll over, and if it doesn't come down under 4 or 3% by 2023 or whatever, over the next 6 to 12 months, then it becomes a really, really difficult thing for the Fed. It becomes a difficult challenge. Because then if unemployment goes up, yeah, that's it. We're in a lot of trouble if that happens. So kind of a long answer, but yeah, if things worsen over time for the economy, especially on recession and unemployment front, and inflation doesn't come down, then I absolutely do believe that the QQQs can see lower lows for the year, and we can certainly go lower. But if inflation continues to show us improvement, unemployment stays where it is, and the economy just kind of pushes through, even though technically first 2 quarters we saw negative declines, negative GDP, even if we continue to kind of push through, we should be in a much better place from the Federal Reserve's perspective. All right, so let's see here. Stefan, welcome on board. Kevin, thank you so much for joining. Really appreciate it. And let's see, the real estate market is already churning. Demand completely wiped off in a number of markets. Yes, so I'm starting to hear that as well. Although I do have a couple of friends that are working as real estate agents or realtors, and they've been telling me that for their specific markets, the market is still hot. So there's been some mixed signals, but you're right. I think overall, in general terms, the real estate market is starting to kind of cool off a little bit. And this should not really be a surprise to anyone, because as quickly as the prices went up for real estate because of all the easy money policies, lots of inexpensive borrowing, it would not be surprising to see a little bit of a different effect when mortgage rates are going higher, back over 4%, 5%, and of course real estate prices to also cool off. Now, I don't know much about the U.S. real estate market because, it's for me to call it like a full-blown crash or anything, but I do expect a pullback. I do expect prices to cool off a little bit, but in terms of a crash, it's hard to really say if there's going to be a real estate crash. So Peter says, my house is on sale and has no bid for the past 2 months. Really? 2 months? That's a long time. Usually like when I was seeing like when the real estate market was hot is like within few days you used to get offers. And not only offers, you used to get like way above asking, right? So bids were way above asking price, and there used to be like multiple bids. But yeah, 2 months is pretty crazy if that's the case. So if the Nasdaq goes down more, what stocks are you planning to buy? What is your target? So great question. So again, there's a lot of stocks that I'm really paying attention to, a lot of different sectors and industries as well. But specifically for Nasdaq related names, I would be looking at AMD. Absolutely. I think anything sub $80, sub $75 would be, in my opinion, very good pricing from a valuation standpoint. Google is another one that I would be very interested in, sub $100. If it comes down to 90 or lower, I would be very much interested in Google as well. Microsoft and Apple are 2 companies that I do think are great solid companies, but it's just that, valuation wise, this is really high. So I haven't really touched these two in a very long time. And of course, Tesla, you guys all know what's going on with Tesla, and what my fair value, intrinsic value really is. So that's another company that I'll be paying attention to. And then of course, Nvidia is another NASDAQ name that, of course, if it comes down to 100s, low 100s, 120s, then I would definitely be looking into this company as well. Would be very interested. So those are just the big ones. And of course, some other companies, S&P Global, Lamb Research. We've done a lot of videos on, lots of companies that I really like, but it's just about valuations, right? It's just about finding the right price. I was gonna do a video very soon where the title of the video was simply gonna be that every single stock in the market is a buy. Literally every single stock is a buy, right? All 8,000 stocks in the market are gonna be a buy, but the only difference is what price you pay for it, right? There's going to be great companies worth buying at much, much lower prices, right? Much lower prices, because every company has a value, right? We just got to figure out what that value is and how to pay less for where it's trading, right? Or for what it's worth, for what the value is. So that's the name of the game, right? Even the companies that you may not like, even the companies that you might hate, if you get them for like, let's say $1, right? And you get like a 98% discount, of course, there's going to be value there, right? So, Oscar says Canny was wrong. Now he's buying SoFi. Yeah, let's see where SoFi is. Up over 1% pre-market. So at the moment, just trading at 617. So SoFi also has pulled back quite a bit, 28% after very, very strong rally. I mean, see, it kind of happened in reverse for SoFi. It actually took the elevator up and then staircases down, right? For SoFi, it actually went up too much too fast. And then it started to roll right back down. It also filled this gap. So, this right here is the gap that it also filled. So that gap is no longer valid, and the support level once again stays put at $5, $5.12, $5.10. So that is going to be that, support level to pay attention to for SoFi. So that would be the level I would really be watching. And I've done analysis on SoFi. So, let's just do the analysis on SoFi right now. Let's just do it live. And all I'm going to do is I'm going to take the earnings. Well, actually, I can't take the earnings. I'm going to take the revenue number for SoFi. So, and Oscar, I need your help with this, right? Since you're the most bullish on SoFi, and since you probably have, among all of us, the most shares in SoFi, because right now I have 0, we will ask for your expertise on where you believe SoFi is actually worth. So if you come over to the actual, let's say, revenues, right? So if you come down, all right, let's see here. So this is the guidance from the company, right? So adjusted revenue, they're expecting about 1.5 to 1.513 billion dollars. That's their 2022 guidance for revenue, 1.5 billion, right? So we're gonna use a different spreadsheet for this one because again, we don't have actual positive earnings or cash flows or EBITDA. We've got an adjusted EBITDA, but that's not what I like to use. So we're gonna go with 1.510. That's 2022 sales, right? Actual top line revenue, right? That's going to be the number because again, if you come back over here, 1.08 to 1.13, I'm taking the mid guidance right in the middle, 1.10, 1.510, so 1.5 billion. And that's going to be a 49 to 50% growth for the company. So if you take a look at their growth, the actual annual revenue growth, they grew by 87% in 2019, 38% by 2020, 63% in 2021, and now they're guiding for 49 to 50% in 2022. So when it comes to SoFi's growth, right, the actual revenue growth, what does everybody believe? What does everybody think is appropriate for revenue growth over the next 5 years? What is the growth rate that everybody believes is going to be appropriate, that SoFi is going to be able to achieve that number in terms of growth for revenue for the next 5 years, all the way out to 2027? So Oscar says use 38%. All right, so I'm going to go with 38%. I'll wait for a few more people to comment to see if they're in line with what Oscar's saying, or if anybody else has a different analysis or perspective on SoFi's growth. Let's see if you can find the growth here as well. Let's see what the revenue growth. So they're expecting, again, 52%, but we don't have anything else. But yeah, that is not high. I think, yep, 38% I think is reasonable. It's not high at all. All right, so Mushtaq says 25%, Parl says 30, Kevin says 30. So, why don't we go 35%, right? 35% growth for SoFi, because again, it's in a very, very high growth sort of cycle right now. You know, over the last 4 or 5 years, you can already see the growth has been phenomenal. 87%, 38%, 63%, 49 to 50%. So if they can continue to do more or a little bit less, it's going to average out around 35%. Now, when it comes to fintech companies in general, right, when you come over to the valuations, you'll notice that SoFi at the moment right now is trading at 4.2 times sales, right? Which, if you take a look at the industry, the sector that it belongs to, the sector median is a 3, and on a forward basis, it's now trading at 3. Now, there's obviously an argument to be made that yes, price to sales multiples have compressed so much because the entire market's been selling off, but what price to sales multiple do you think is appropriate for SoFi? Is it 4? Is it 5? Is it 6, 7? Apple trades at 7. We've got other companies, you know, such as Upstart and PayPal and some of those companies. What is PayPal trading at in terms of price to sales? So PayPal right now trades at about 4.26, right? 4.26 for PayPal. Upstart is trading at, so Upstart is trading at 2.23. So Upstart definitely has been sold off quite a bit here. And then Affirm is trading at a price to sales multiple of 7. So Affirm's a little bit higher at 7 times sales. Which other company I think we can look at from a fintech, from a SoFi standpoint? No, I'm just comparing that to price to sales multiple. That's all it is. Ally Financial, we can take a look at that one as well. See what price to sales multiple they're trading at. They're trading at 1. Visa, MasterCard are going to be much higher. So obviously they're going to be, but they're also like payment processing. PayPal is also payment processing. Upstart is again lending, but AI lending on a more credit basis. So I think Square, let's take a look. Square might also be a good comparison for SoFi. They're trading at 2.65. So every company that we have looked at right now, anywhere between 2 to as much as 5, right? Square is 2.65 per month. So Parlo says 5 to 6. So what does everybody think? What is the appropriate price to sales multiple for SoFi, and where it should be appropriately valued at? Let me know. So Oscar says 4. I think 4 is also reasonable. 4 is being on the conservative side for this company. Yes. So Piyush, I think you bring up a great point. So 3.5, 5, 3. All right. So we're getting between 3.5, 3, and 5. So we're going to go with 4. I think 4 is right in the middle. That's going to be that number. And then the discount rate that we're going to use is going to be 12%, because again, we want a little bit higher discount rate than what the market's giving us, which is again going to be the 10% on average, and the margin of safety. Now here's the thing. With margin of safety, usually my price to sales model, I actually go with a much higher margin of safety, because for a profitable company, I can go with 10%, right? Over here, you see 10%. I can go with 10% margin of safety because it's a profitable company. I've looked at the balance sheet, all those things that kind of make sense. But when I'm looking at a company that, you know, again, may not necessarily have gap adjusted profitability or positive EBITDA or positive free cash flow, I go with a little bit of higher margin of safety, right? That simply means that whatever the discounted intrinsic value is, discount even further 20% or 30% from the intrinsic value. That leaves for more room for potential safety there, right? That's building a safety net pretty much. So I'm gonna go with 20% margin of safety. And even then, I think the intrinsic value is sitting at almost $13 billion for SoFi. And the market cap right now is sitting at just over 5.6, right? So if you take a look at the actual market price, 5600. So that definitely does suggest that SoFi, based on these estimates, 35% revenue growth and a 4 times price to sales multiple is currently undervalued, just simply based on a price to sales multiple, not taking into account earnings, not taking into account free cash flows, not taking into account anything else when it comes to EBITDA or profitability. So execution is going to still be a very, very important factor for analyzing companies like these. So if they don't execute, obviously they're done. But if they do execute well, then of course there's going to be a lot of return, right? So risk reward really is going to be high at this stage of their business for SoFi. So yeah, I mean, Oscar, I couldn't agree with you more. You know, it's a very solid company. It's a great company. I fully agree. And I know that you don't believe that, but I really do think that SoFi is a phenomenal business. It's just that, you know, once it starts to become profitable. Oh my God, you are just so funny. You're just always putting words in my mouth. But no, like SoFi, but need to see more improvement when it comes to execution. Might even take up, like I said, $5 comes down to $5. I will be looking at leaps for SoFi. So if you come over to our Webull, see how much leaps are worth for SoFi. Let's see here, options. I'm gonna go deep in the money. January 19. So $5 leaps are gonna be for, yeah, it's not really gonna make much of a difference if I end up buying this one. Yeah, so I'll pretty much be spending the same amount of money as I would be for buying 100 shares. So I might as well just buy 100 shares for SoFi when it comes down to those levels. So yeah, $5 is what I'm going to be paying attention to for SoFi. So that's what we're going to be paying attention to. All right, so what other stocks are we looking at here? Let's take a look at. Yes, so I actually did a video on Zoom. I did a video on them earlier, so make sure that you do check that out. They actually cut their guidance and they missed on the future revenue and earnings estimates as well. And as a result, they are down over 9.2%. So 2 videos I already did for companies that reported earnings. Zoom was one of them, and the other one was Palo Alto Networks, which is up over 9.5%, almost 10%. So both of those I did videos on earlier. So make sure that you check them out if you haven't already. So Trade Desk, let's take a look. So TTD is up over 1.5% right now. It's still got a huge gap to fill on the downside. So this right here is going to be that gap that Trade Desk may want to fill, on the downside, because it gapped up after the earnings. It rallied over 36%, and now we're starting to curl right back down. And we have pulled back over the last couple of days. So Trade Desk, I know that this stock also trades at a little bit of a rich valuation. So, over 1,000 times earnings. So if you take a look at their, I'm going to close out this. And then we're going to quickly go over to Trade Desk here. I know the valuation for Trade Desk is also really high. So, price earnings on a gap adjusted basis forward 64. And then on a non-gap basis 64, and a gap adjusted basis 913, 792 on a forward basis, and then enterprise value to EBITDA 48, price to sales at over 19, almost 20 times sales, and then price to cash flow at over 61. The best way I used to explain price to sales multiple was simply, in a way that, okay, let's say that you open up a pizza shop, right? Let's say that you decide to go into business and you open up a pizza shop. And in your first year, you basically generate revenue, right? You make sales, the revenue that you make by selling pizza is $1,000, right? Let's say that's how much you make, $1,000 in revenue, right? In sales by selling pizza. Is your company, that pizza shop, is it worth $20,000 after that first year? That's a question. What would be the answer? Is it worth $20,000 after the first year? If you sold $1,000 worth of pizza running that business? Again, this is not a very, very simplistic way of trying to understand what that price to sales multiple kind of looks like in a more logical sense. But yeah, let me know in the live chat. What do you think? Yes, so Dominda, I will be sharing some ideas for cash secure puts here shortly. When the markets continue to sell off, we will be looking at some CSPs. So, what do you think? Let me know in the live chat. Because 19.65 times sales is where Trade Desk is currently trading at, right? It's literally just valued at almost 20 times the sales that it generated, which, ask yourself, right? Just taking into account that simple explanation or that analogy, if that fits well, ask yourself if that's appropriately valued or if that's really, really high. Would you go to a business and pay 20 times the sales that they did last year, right? That's a more logical question, is that if you would go to that pizza shop that did $1,000 last year in sales and pay them $20,000 to buy their business, would you do that, right? If the answer is no, then we can make the same argument here that 20 times sales, regardless of how good the sales growth is, like Trade Desk could be growing at 100, 200%, but even then you got to account for the valuation. You got to account for the price you're paying for the business, right? Always think of it as you're paying for the business as a whole, right? Not just the stock price. So Oscar says 20 times is cheap. Look at Apple 28. So we're talking of two different things, Oscar. We're not talking about earnings. Apple is trading at 28 times earnings. That is the bottom line. That's profit. We're talking about sales, right? Trade Desk is trading at 20 times sales. Apple is trading at 7 times sales. So if you come over to Apple is probably trading at 6 or 7 times sales. Probably 7 now because it's pushed up. There we go. So Apple is trading at 7 times sales, right? So Trade Desk is more than twice price to sales multiple. So earnings is a little bit different. Earnings is the bottom line. And earnings multiples usually are higher. They are up to 20, 25, 30 levels. But price to sales, most of the times you'll see them in the single digits. 6, 7, 8. Very rarely you'll see a company trading at 12, 14, 16 times sales. And cybersecurity companies are one sector that hasn't really gotten down yet, right? I mean, it's still trading at very, very high levels. And Trade Desk, of course, in the advertising business, kind of like the opposite of what PubMatic does, it's still trading at a very, very high multiple. So it's got a gap to fill here. $40 is going to be that support. I know they did a stock split recently, not too long ago, back in June, 10 for 1. So next support is going to be $40. Kevin says tacos. Yeah, you can do a taco business too. I mean, it's the concept the same, right? So yes, SWK, by the way, a few more companies. So Han mentioned SE, so C Limited. I think I've done a video on them in the past. I think they reported earnings, but since then they've been selling off. So revenue was a little bit of a miss. EPS came in better than expected, but still generating a loss per share here. And the support level is going to stay put at $54. So this right here is going to be that level to watch as a support for Trade Desk. And of course, resistance is going to stay put around here at close to $93, $94. And yes, for cash secured puts, I will be posting some ideas. Still need the markets to come down a little bit because cash secured puts are most efficient when there is an expectation the market's going to go higher. And covered calls are best utilized when you expect the markets to go down, right? And the reason why I don't want to be selling cash secured puts now is because I'm still expecting some more potential downside. And if I sell cash secured puts now, the chances of assignment will be very, very high as opposed to just collecting the premium. So I will be waiting for CSPs a little bit longer. I will be waiting for the prices to come down a little bit more. Mostly at support levels is when I would be looking to sell cash secured puts. But right now, the strategy would still be to protect and hedge against potential downside by selling covered calls or even buying puts or at least trading at least something in the inverse direction to hedge further downside. So hope that kind of makes sense there. Let's see. Yes. So Oscar, there are going to be. So if you, I'll send you that. I'll send you that by the end of this week. I promise. I'll definitely send you that so we can maybe look into that together. There's going to be a lot of things, obviously, and it's going to be a really, really big project and really, really big spreadsheet. But we'll see if we can get that done together. All right. So Trade Desk, we went over. C Limited, I went over the technicals. Lamb Research, actually not Lamb Research. LAC is Lithium Americas Corporation. Okay. So it looks like we have done some analysis. Bigger than rebuilding United. Well, we're not rebuilding anymore. Didn't you hear the news? We ended up beating Liverpool, man. We're good. We're gonna be top of the table very soon here. Liverpool is a club that actually needs some rebuilding, but we are fine. So for Lithium Americas Corporation, I'm assuming this stock actually depends very much on where lithium prices are going. So is a resource company which engages in lithium development projects. A project includes Thacker Pass. Company was founded in Raymond Edward Flood Jr. November 27, 2007, and is currently headquartered in Vancouver, Canada. So support level is going to stay put at $18.75, closer to $19. Do they pay a dividend? I think they do. No, they don't. All right, so we don't have any fundamentals to look at, right? So if you take a look at their income statement, we've got losses across the board. Yeah, we've got shares outstanding going up like crazy. We've got cash flows that are negative. We've got income statement that has no revenue, no EBITDA, negative EBITDA. And of course, so there's nothing that I can analyze here. I'm sorry. And $3.8 billion market cap. So the only thing that I can really go over is the support resistance level and of course the technicals, which resistance is going to stay put at $30. And right now it just looks like we're coming down from an RSI, like RSI MACD starting to roll right back down. So I would be very careful and cautious going long here, just considering that we're coming off of a resistance tag. And of course the MACD is crossing below that signal line as well. Says the live stream chat will be quiet today on the soccer front. Yes, we don't have a lot of people joining in because it's a lot earlier today. All right, so let's see. Micron, MU. So I have done some analysis on Micron before. This is still one of those companies that trades at a very, very discounted level. In other words, very cheap valuation relative to its earnings and cash flows and whatnot, with respect to some of the other companies that are within the same sector. So you'll notice a Micron still trading at under 7 times earnings, 2 times sales, cash flows trading at 4.4 times, and enterprise value to EBITDA at under 3.5. So, really, really cheap valuations. Shares outstanding has pretty much been stable. In fact, it's been going down in the last few years. The balance sheet for the company, if you take a quick look, total assets here. So they've got a very good balance sheet as well, more cash than debt on the balance sheet. So we've got a negative net debt, which is always a good thing. And then if you take a look at the income statement, let me just remove some of these things here first. So if you take a look at the income statement and, if you just look at the actual revenue that has been growing over the last 6 to 8 quarters, and then the net income as well over here. So not only the revenue number has been growing over the last several quarters, also the actual net income. They have struggled a little bit in the past. It was going up from 2015 to 2018, then it kind of went down 3 years in a row, and then 2021 was a very good year for Micron. So in the last few quarters, we have seen very consistent, strong growth in revenues and profitability. So Micron, I really like, and it's also got a decent dividend. I mean, just a little bit under 1%. So support level is going to stay put at $54, $55. But again, it really is a question of whether they can reignite that growth in the future once again, if they can reaccelerate their revenue and earnings growth moving forward. Just because 2021 was a strong year with respect to 2020 doesn't necessarily mean they're going to continue to do that, because the last 3 years, they were on a consistent decline, right? These 3 years, they were just going down. So future revenue growth, earnings growth very much is going to be directing the stock whether it goes higher or lower. So $54, $55 is going to be that support. But overall, I like the balance sheet. I like the share buybacks. The margins are good. And so far, it's been moving in the right direction. So Oscar, what is the difference between MicroStrategy and Coin? People seem to like one or the other. Is Coin not a safe way to get some exposure in crypto upside action? So Coinbase really is an exchange that facilitates all crypto transactions, right? Whether you're buying or selling. So think of it as an exchange, right? That doesn't necessarily have any direct exposure to Bitcoin and the daily fluctuations. So it's just an exchange. And if crypto prices are doing better, if they're going higher, that means more trading activity, more liquidity, more fees that Coinbase will benefit from, and the earnings and the revenue will also grow. Whereas opposed to MicroStrategy, as far as I think I'm aware, they actually own Bitcoin on their balance sheet. I could be mistaken, but I think they are. They own Bitcoin on their balance sheet, which obviously, is pretty much direct exposure to BTC. So, those are the two, I think, main key differences between Coinbase and MicroStrategy. Coinbase is an exchange, and then MicroStrategy is a company that actually owns directly Bitcoin. Dan says, I'm only buying GameStop. How is AMC doing, by the way? AMC yesterday, wow, 41%, 42%. That was a pretty significant sell-off here in just one day. Selling right back down pretty aggressively. And yeah, just in one day, the RSI literally came down to 31. So almost at oversold territories once again. And of course, $9.75, close to $10 is going to be that support level to watch. So Bharat, tell me about some solar stocks. If there's any stocks you want me to go over, just let me know. I'm happy to analyze any solar stocks for you. So if there's any companies you want me to analyze, I'm happy to go over that. But yeah, 975 is going to be that support level to watch. Mike, what do I think about Ape? So again, I'm not really, following up with AMC or what's going on with this stock or with this company, unfortunately. So can't really share any opinions there. But I know that, it says there was some trading activity at 1950. Right now, trading at $6. So yeah, I'm not really looking into this or interested in this or buying or anything like that. So just been watching it. So Jonas, what's the difference between Google GOG and GOGL? So one of them actually comes with the voting rights. The latter, GOGL, I'm pretty sure that one comes with voting rights, and the first one does not. That's the only main difference, nothing else. You get the same ownership, it's just a different class of shares, and the other one comes with voting rights. That's all it is. SWK, all right, let's take a look. Stanley Black & Decker. Interesting company. Let's see, 94.26. It's got a nice 3.3% dividend yield. Very nice, consistent revenues, and earnings have also been very good. If you take a look at the valuation, trading at 16 times earnings, 11 times enterprise value to EBITDA, under 1 time sales. Let's take a look at the margin. So return on assets is really low, 3.5%. Return on equity, 9.5%, which is okay. And return on invested capital at 6.24%. This can definitely get a lot better. Not super great, but definitely can get better. Gross margins at 26-27%. And then we got operating margins, 8.27%. And net margins at 1.8%. So they're literally just only making 1.8%, 2%. For every dollar in revenue this company generates, $2 comes down to the bottom line. 2 cents. 2 cents, not $2. For every $1 in revenue the company generates, 2 cents comes down to the bottom line as actual net income. So these are like really low margins, unfortunately. And then quick ratio, current ratio is also not over 1. Let's take a look at their balance sheet very quickly. So total cash over total debt right now. So they've got plenty of debt, over $11 billion in debt versus only $288 million in cash. So balance sheet's not super great, unfortunately. And share buyback is good. So they have been buying back shares, not in the last 5 to 6 years, but looks like since Q4 of 2020 from 160 million down to 147. So that is good. So we got a company which has a low valuation, lots of share buybacks, low profitability, low margins, not the best balance sheet. And in terms of growth, we've got revenues pretty much growing from 11 billion all the way up to 15.26 billion. So that's decent growth there for the company. And the net income has gone from 883 million to over 1.6 billion dollars. So not bad either for the revenue and the earnings growth. So for this one, what does it even do? Let me just see. Engages in the provision of power and hand tools, related accessories. Okay. So yeah, I mean, hardware, equipment for oil and gas infrastructure applications, you're not going to find high margins for them. But, they've got a very strong uptrend. I mean, they've got a really, really nice uptrend, looks like. They've just been on a consistent rally. This is since 2001. I mean, they've gone up over 800%. If you bring up the moving averages here, so yeah, they've been on a very, very nice consistent uptrend overall. So yeah, support level, I would keep a close eye here at around these levels. $88, $87 for SWK. RSI, MACD both oversold on the weekly time frame. So wouldn't be surprised if we do get a little bit of a bounce back higher for this company. So Jonas, Google under 110 is a good deal. So Google under 100 would be a fantastic deal. I would say Google under 100 would be a decent deal. But Google under 100 would be fantastic, and Google under 90 would just be crazy. It was like be out of the world. So I can even put the words here if you want. You know, under 110, it's like decent. Decent over here. Under 100, we got fantastic. And what other adjectives we can use for under $100? Closer to 90. What other adjectives? Like out of this world or just absolutely crazy? Robbery. Robbery is nice. Glorious is also nice. Robbery, I think I'm going to use robbery. Robbery is really good. Christmas, yes, I like Christmas too. But under 100, I think robbery is funny. It's really good. So yeah, that would be some price levels to watch on Google. Because, you know, we've talked about the valuation for Google, and it's just insane. If you come over to my Excel spreadsheet, hopefully I have that here. There we go. You know, if you take a look at this entire spreadsheet and you look at the revenue growth for Google, 27% over the last, 17 years or so. Gross margins have been very, very stable. Operating margins over here. We've got net income growing at 28% and net margins of 28%, at least 25 to 28%. And then market cap right now for Google is at 1.496. So I need to update this. 1.496 is going to be the current market cap. Of course, plenty of cash versus debt, so negative net debt. And then look at the valuation where we are. I mean, we are trading at, all right, I need to update this. Yeah, I need to update that one. So price of free cash flow would be simply the market cap divided by the free cash flow. And then price earnings would be the price market cap, which is, and then divided by the earnings. And then price of sales is going to be the market cap divided by the expected 2022 revenue numbers. Okay, so yeah, under 5 times sales, under 20 times free cash flow, and under 18 times price to earnings multiple. If you take a look at where Google has traded in the past, never in these stocks history, it's traded at these valuations. And this is only at 1.5 trillion, right? If it comes down to that robbery price, which we've been talking about, which is going to be another 20% drop, right? So you take this number times 0.80 and you get to $1.2 trillion market cap, and then the valuation comes down even lower. It would be trading at about 14 times earnings, 16 times free cash flow, and under 4 times sales, right? That's why we've got the robbery there, is because it would just be crazy for Google to be trading at those levels. Yeah, that's where we are. So, all right, everybody. So that's going to be it for today. Ray, a little bit earlier today, we've been live for almost an hour because I do have a family obligation at 9 a.m. Eastern, so I will be away for about an hour or so. So won't be able to go live during the market open. So figured I'd do one prior to the market open to help you kind of analyze some stocks, kind of talk about what's going on. So thank you so much for joining, everybody. I do have a Tesla video coming out later today, so that's going to be very, very important. So make sure that you do check that out because tomorrow is the last day for Tesla to be a shareholder for the stock split. So all the details will be included in that video. And of course, did a video on Palo Alto Network and Zoom as well. So make sure that you also check out if you're interested in those 2 companies. So thank you so much for joining. I really appreciate it. Make sure that you drop a like and of course subscribe if you're new to the channel and joining us for the first time. And links to our Discord and Patreon is going to be down in the description below. So hope you all have a great day. And I will be in our Discord answering questions, still engaged over there. But unfortunately, just won't be able to be live at the market open today. So thank you so much. As always, happy investing. I'll see you guys